Is trading profitable in 2024 or 2025? Trading can be profitable in 2025, but success depends on various factors, including market conditions, strategies, and the trader's knowledge and risk management skills. Here are some key aspects to consider for trading profitability in 2024 or 2025. 1. Market conditions. The performance of stocks, commodities, forex, and cryptocurrencies can be impacted by factors like inflation rates, interest rates, geopolitical events, and economic policies. In 2025, as markets adapt to evolving global events, volatility may create both opportunities and risks for traders. 2. Trading strategies. Choosing the right trading strategies, such as day trading, swing trading, or longer-term investments, is crucial. Automated trading, algorithmic strategies, and quantitative approaches are gaining popularity, and staying updated on new strategies could offer a competitive edge. 3. Technological advancements. The use of artificial intelligence and machine learning in trading is becoming more sophisticated. These tools can help traders analyze patterns, automate trades, and improve decision-making, potentially increasing profitability.
4. Risk management. Effective risk management is essential in trading. Using tools like stop-loss orders, position sizing, and diversification can help limit losses, even in a volatile market environment. 5. Education and experience. Success in trading generally requires continuous learning. Staying informed about market trends, economic data, and the latest developments in trading technology can enhance a trader's ability to make profitable decisions. 6. Fees and costs. Minimizing trading fees, such as brokerage fees, spreads, and transaction costs, can impact profitability. High-frequency traders, or those with substantial volume, may especially need to consider these costs. In summary, while trading can be profitable in 2025, profitability is not guaranteed. Traders need to be prepared to adapt to changing market conditions, invest in their skills, and use disciplined strategies to increase their chances of success. Market conditions in 2025 are influenced by a variety of global economic, political, and technological factors. Here are some key elements likely to impact trading markets this year. 1. Economic growth and recession risks. The global economy is expected to grow slowly in the coming years, partly due to inflationary pressures, high interest rates, and ongoing adjustments after the COVID-19 pandemic. Some regions might face recession risks, especially if central banks maintain high interest rates to control inflation. 2. Inflation and central bank policies. Central banks, particularly the Federal Reserve, Fed, European Central Bank, ECB, and others, will play a critical role in 2025 by setting interest rates and other monetary policies to control inflation. Higher rates can make borrowing more expensive, which typically slows down economic growth but may strengthen currencies, affecting forex markets. Lower rates could stimulate spending and investment, supporting stock markets. 3. Geopolitical tensions and trade policies. Tensions among global powers, e.g., the US, China, Russia, and the EU, can lead to uncertainty in markets. Trade restrictions, sanctions, or tariffs can disrupt supply chains, impacting commodity prices and stock markets. For example, ongoing conflicts, particularly in energy-producing regions, could lead to fluctuations in oil and gas prices. 4. Technological innovation and the digital economy. Advancements in technology, especially in artificial intelligence, blockchain, and green energy, are influencing various markets. For example, Tech companies innovating in AI and machine learning could see growth in their stock value, while energy companies focused on sustainable practices might attract more investors. The growth of digital currencies and decentralized finance, DeFi, could also reshape how capital flows across global markets. 5. Climate change and environmental policies. Climate change remains a pressing issue, and regulatory measures to address it are likely to continue expanding. Policies supporting green technology, renewable energy, and carbon reduction can influence markets by impacting industries like energy, automotive, and manufacturing. Companies prioritizing ESG, environmental, social, and governance standards may attract more investors, potentially making this a profitable focus area. 6. Consumer spending and labor market trends. Consumer behavior and labor trends impact both corporate earnings and stock prices. If consumer spending remains stable, it can support growth in sectors like retail, travel, and leisure. However, if labor shortages or wage inflation persist, they could increase operating costs for businesses, affecting profit margins. 7. Cryptocurrency and regulatory landscape. The cryptocurrency market is still evolving, and regulations are expected to become more defined by 2025. Increased regulation may reduce volatility and attract institutional investors, while also impacting individual crypto projects. The development of central bank digital currencies, CBDCs, could also reshape the landscape, offering new opportunities and challenges for traders. 8. Commodity prices. Commodity prices, including those for oil, gas, metals, and agricultural products, are likely to be influenced by supply chain conditions, weather events, and geopolitical factors. High commodity prices can benefit commodity exporting economies and companies but increase costs for others, impacting stock performance. In conclusion, market conditions in 2025 are likely to be a mix of challenges and opportunities, shaped by economic policy, geopolitical events, and shifts toward technology and sustainability. Traders who stay updated on these trends and maintain a flexible approach may find profitable opportunities in this evolving environment. Cryptocurrency. Trading strategies, technologic advancements, risk management, education and experience, fees and costs. Here's an in-depth look at each of these areas in trading for 2025. 1. Trading strategies. Algorithmic and quantitative trading. Algorithmic trading continues to grow as technology advances. Traders use algorithms to execute trades at high speed and frequency, capitalizing on small price movements. In 2025, quantitative strategies, including statistical arbitrage, are expected to be popular, especially among institutional traders. Momentum and swing trading. These strategies are ideal for volatile markets, as traders capitalize on short to mid-term price trends. Swing trading, for example, involves holding positions for several days or weeks, taking advantage of momentum and reversing trends. Value and growth investing. While more common among long-term investors, value and growth strategies remain relevant in 2025. Value investing focuses on undervalued stocks, while growth investing targets companies expected to grow faster than the market. Social trading. Platforms that allow users to follow and copy the trades of successful traders are growing in popularity. For beginners or part-time traders, social trading can offer a lower-risk introduction to the markets by following experienced traders. 2. Technological advancements. AI and machine learning. AI-driven tools that analyze massive datasets are being used for predictive analytics, identifying patterns that can help in decision-making. Machine learning algorithms adapt to changing market conditions, optimizing trading strategies in real time. Natural language processing (NLP) tools can analyze news, social media, and other unstructured data sources to gauge market sentiment, providing insights into market trends before they materialize. Blockchain and decentralized finance. DeFi blockchain is improving transparency and security, particularly in cryptocurrency trading. The growth of decentralized exchanges, DEXs, allows traders to access new markets with reduced fees. High-frequency trading, HFT, leveraging cutting-edge hardware. High-frequency traders execute thousands of trades per second. HFT is accessible mostly to institutions, but individual traders can indirectly benefit by understanding market liquidity dynamics driven by these algorithms. 3. Risk management. Stop-loss and take-profit orders. These orders are essential in limiting losses and securing gains. Stop-losses close a position once it reaches a set loss level, while take-profit orders lock in gains. Position sizing and diversification. Position sizing involves determining the amount of capital allocated to each trade, considering risk tolerance and account size. Diversification, spreading investments across asset classes, helps to reduce exposure to any single asset's risks. Leverage control. While leverage can amplify gains, it also increases risk. Setting strict leverage limits and ensuring adequate margin in accounts can prevent forced liquidations in volatile markets. Risk-adjusted metrics. Using metrics like the Sharpe ratio or Sortino ratio can help traders understand the risk-return profile of their strategies and make better decisions about capital allocation. 4. Education and experience. Market analysis skills. Fundamental and technical analysis remain essential for assessing market conditions. In 2025, understanding economic indicators, corporate earnings, and technical chart patterns is as important as ever. Backtesting and paper trading. Backtesting allows traders to test strategies against historical data, while paper trading lets them practice without risking real money. Both are crucial in honing skills and adapting strategies before going live. Continuous learning. Markets evolve, so it's critical for traders to stay updated. Online courses, trading simulations, and access to research materials and webinars are valuable for learning about new strategies, technologies, and tools. Psychological training. The psychological aspect of trading, including managing emotions and maintaining discipline, is often overlooked but essential. Training on handling stress and decision-making under pressure can make a significant difference. 5. Fees and costs. Brokerage fees. Brokerage fees can add up, especially for high-frequency traders. Choosing low-cost brokers that offer competitive spreads, low commissions, and quality execution is essential for maximizing profitability. Spreads and slippage. Spreads, the difference between buying and selling prices, can vary widely depending on market liquidity. Slippage, the difference between the expected price of a trade and the actual price, can be costly in fast-moving markets. Platform and subscription fees. Many traders use specialized trading platforms and software that require monthly or annual subscriptions. These costs need to be factored into the overall trading budget. Data and analysis costs. Access to real-time data feeds, news, and analytical tools often requires paid subscriptions. Quality data and tools can improve trading decisions, but add to the operational costs of trading. In 2025, trading can be profitable with the right strategies, technology, risk management, education, and cost awareness. By staying informed, using the best tools, and practicing disciplined risk management, traders can maximize their chances of success in a competitive and evolving market.